Most crypto investors handle their taxes completely wrong. And here's what nobody tells you. The IRS collected $28 billion from crypto investors last year alone. Not from criminals, not from whales running offshore accounts, from everyday people. People just like you, who bought Bitcoin, maybe flipped some altcoins, and had absolutely no idea the rules they were breaking. Here is the thing that should terrify you. The IRS does not need you to file incorrectly on purpose. They just need you to not know. And most people do not know. In 2021, the IRS sent warning letters to over 10,000 crypto holders. In 2023, that number exploded. Coinbase, Kraken, and Gemini are legally required to report your transactions. Your exchange already told on you. The question is whether your return matches what they said. If it does not, you are not just leaving money on the table. You are lighting it on fire and handing the ashes to the government. Stay with me, because in the next 10 minutes, I am going to show you exactly how this happens, why smart investors still fall into this trap, and the specific moves you can make right now to legally keep more of what you earned. Here is the myth that is quietly destroying crypto portfolios right now. The myth is this: crypto taxes are simple. You buy, you sell, you pay taxes on the profit. That is it. Easy. Done. Thousands of people believe this. They think crypto taxes work exactly like selling a stock. You made money, you owe a percentage, you move on. And because it sounds so straightforward, they never dig deeper. They file their taxes using the same basic software they have used for years, click through the crypto section in about 4 minutes, and assume everything is fine. They are not fine. That oversimplification is exactly what cost one Reddit user $60,000 in unexpected tax liability in April 2022. He posted his entire story, made $200,000 in gains during the 2021 bull run, sold in early 2022 when the market crashed, thought he broke even, and then got a bill that nearly destroyed him. He did not understand the rules, and the IRS absolutely did not care. So why does this myth survive? Why do intelligent, financially motivated people keep falling for it? 3 reasons. First, crypto still feels new. Even though Bitcoin launched in 2009, most retail investors entered between 2017 and 2021. To them, this asset class is young, fast-moving, and feels like it exists outside the normal rules. That feeling is dangerous. Second, the exchanges themselves make it confusing. Before 2023, most exchanges gave you a basic CSV file and called it a day. If you traded across multiple platforms, say Binance, Coinbase, and a DEX like Uniswap, you were expected to manually reconcile thousands of transactions yourself. Nobody told you that. Third, and this is the big one, the gains felt so large that the taxes seemed abstract. When your portfolio goes from $5,000 to $80,000, a 30% tax hit feels theoretical until April arrives. And suddenly, that $80,000 has already been spent, reinvested, or lost in the next crash. The money is gone. The tax bill is not. But here is where the myth starts to fall apart. The IRS did not wait for you to figure this out. Back in 2014, 10 years ago, the IRS issued Notice 2014-21. That single document classified cryptocurrency as property, not currency. That one word, property, changed everything. It means every single transaction is potentially a taxable event, not just selling for dollars. Trading Bitcoin for Ethereum, taxable. Using crypto to buy an NFT, taxable. Getting paid in crypto, taxable as ordinary income at the moment you received it. Staking rewards, taxable. DeFi yield, taxable. An airdrop landing in your wallet, taxable. You did not buy anything. You did not sell anything. Tokens just appeared. And the IRS says you owe taxes on the fair market value at the moment they appeared. This is not speculation. In 2023, a federal court upheld this position in Jarrett v. United States. The IRS is not guessing. They are enforcing rules that have been written since 2014. The question is whether you knew that. Let me give you real numbers, because this is where most videos go vague, and I refuse to do that. According to Chainalysis data from 2023, only 1.62% of global crypto users reported their crypto taxes. 1.62%. In the United States, that number is higher, but IRS estimates still suggest massive underreporting. The agency has allocated over $80 billion in new funding specifically to expand audits, and crypto is a priority target. In 2022 alone, the IRS Criminal Investigation Division seized over $7 billion in crypto linked to fraud and tax evasion. They have an entire team called the Digital Asset Cyber Crimes Unit. They are not playing. On top of that, starting in 2024, brokers including crypto exchanges are required under the Infrastructure Investment and Jobs Act, yes, the Roads and Bridges Bill, it had a crypto provision, to issue 1,099 DA forms directly to the IRS. Your exchange is filing your income before you even open TurboTax. If your return does not match, a computer flags it automatically. No human needed. So what is actually happening here? The real explanation is not that crypto investors are cheaters, it is that the tax code was designed for a financial system that does not trade 24 hours a day, across dozens of blockchains, with assets that fork, split, merge, and generate passive income simultaneously. The rules exist. They are just extraordinarily difficult to apply without help. Here is what the tax code actually rewards, and this is important. It rewards patience. The IRS splits capital gains into two buckets. Short-term gains, assets held less than 12 months, are taxed as ordinary income. Depending on your bracket, that could mean 22%, 24%, even 37%. But long-term gains, assets held for more than 12 months, are taxed at either 0%, 15%, or 20%. That gap is enormous. If you made $50,000 in crypto gains in the 24% bracket on short-term trades, you owe $12,000. Hold those same assets for 1 year and 1 day before selling, and depending on your income, that bill drops to $7,500 or potentially zero. The government literally rewards you for not panic selling. And most people never take advantage of it because they do not know it exists. This is where it gets practical, and this is where you need to pay close attention. If you want to legally reduce your crypto tax bill, the single most powerful move available to you right now is time. Moving assets into long-term holding status is not just a strategy. It is a legal tax reduction that requires zero loopholes and zero accountants. But here is the nuance. How you hold those assets matters. If your coins are sitting on an exchange, you are one hack, one account suspension, or one regulatory action away from losing access. All right, here is exactly what you do this week. Not someday, this week. Step 1. Pull every exchange account you have and export your full transaction history. Every single platform. Coinbase, Kraken, Binance, MetaMask, every DEX you touched. If you cannot remember them all, check your email for confirmation receipts going back to your first transaction. Step 2. Run that transaction history through a crypto tax software. Coinly, CoinTracker, and TaxBit all integrate directly with major exchanges and blockchains. They automatically calculate your cost basis, your holding periods, your gains and losses. This is not optional. Manual tracking across hundreds of trades is how mistakes happen. Step 3. Identify which of your current holdings are approaching the 12-month threshold. If you bought an asset 8 months ago, do not sell it in month 9. Look. The IRS collected $28 billion from crypto investors last year. I told you that at the start. Now you know why. Not because the government outsmarted anyone, because most people never took 45 minutes to understand rules that have existed since 2014. You now know more about crypto taxation than the vast majority of people holding crypto right now. That knowledge is worth money. Real money. Use it. If this video helped you, share it with one person in your life who holds crypto and has never once thought about taxes. You might save them from a very painful April. Subscribe if you want more breakdowns like this. We go deep on crypto strategy, security, and the stuff most channels are too scared to say out loud. Drop a comment telling me which taxable event surprised you the most. I read every single one. Links to everything mentioned, hardware wallets, tax software, CPA directories, are all in the description below. Disclaimer. This video is for educational and entertainment purposes only. Nothing constitutes professional advice of any kind.